Hello and welcome to the latest Insider interview. Our guest today is Ian Lance, who is the co-manager of the Temple Bar Investment Trust. Ian, thank you very much for coming into the studio.
Pleasure.
Can you give me a quick overview of how you manage money in this investment trust?
So Temple Bar is a classic value investment trust. That means that we try to buy what we consider to be deeply discounted equities for the trust. It's relatively long term, so we tend to think about 5-year time frame. It's quite concentrated, so about 35 stocks and pretty low turnover.
And it's a UK investment trust. You're investing in UK equities.
Correct. So 70% of the trust is invested in UK equities.
So a value investment approach.
Yep.
What does that mean for you as a fund manager?
Okay, so we philosophically we believe that the average investor has a tendency to overreact to things that don't really influence long-term value. So typically, if the earnings of a business go down, the share price will follow it down, and often, actually, that decline in earnings doesn't really impact the long-run value of the business. So what we're trying to do as value investors is effectively look longer term than the average investor. So we look 5 years out. We ask ourselves, where do we think the earnings of that business can get back to on a 5-year view? And then we'll value the business off that. We come up with what we think is the intrinsic value of the business. If we can buy an equity where we see at least 50% upside to that intrinsic value, then that's normally an interesting stock for the trust.
And in the UK then, what types of sectors and companies does this approach lead you to today?
The most attractive one of the most significant part of the trust at the moment is financials. We think that, amazingly, even though the great financial crisis was a long time ago, I think a lot of people were sort of almost scarred by that and virtually swore never to invest in banks again. And therefore, they've missed a massive change in the industry. The industry is so much different from the industry back in 2008. And so we got the opportunity to buy some, what we think are good businesses at very, very low valuations. And that still makes up a substantial proportion of the trust today.
Can you give some examples of some recent buys and sells in the portfolio?
Let's start with the sells, actually, because some of those banks that I was just talking about have done so well that they became a very large part of the trust, and we've taken some money out of them. So if I told you that NatWest doubled last year and has gone up another 30% this year, you can see how that would become a big part of the trust. And so we've taken money out. We haven't sold them completely. We've taken some money out of them. On the other side, what have we been buying? The platinum company, Johnson Matthey. We bought that a few months ago, timed that very well. They sold a business recently called Catalyst Technologies. Although it was only 20% of profits, they got about 80% of the market cap of the company for it. So that's done very well. We bought Smith & Nephew, which is a medical devices company. And then the last one, which I think possibly might interest you a lot, is last year we were buying Aberdeen. And one of the reasons for buying Aberdeen is that we felt that lots of people weren't looking at the interactive investor part of the business and were probably undervaluing it. And lots of people might not even know that within Aberdeen you've got interactive investor, you've got a business called Advisor. At the time that we were buying it, we thought those two bits of the business made up the market cap of the company, and the fund management business was being valued at zero. The fund management business has undoubtedly got problems, but it's definitely not worth zero. And then there are other bits of Aberdeen, a core equity tier 1 surplus, a pension fund surplus, a stake in Phoenix. You add all that lot together, and we thought you were getting to sort of nearly double the market cap at the time we were buying it. So that was another big purchase last year.
Well, that's good to hear. So you're quite an active investor then. So in a given year, what's the kind of normal level of turnover?
Funnily enough, we have been active recently because the opportunity set has been good. But actually, in the long run, our turnover is around 15%. Our average holding period is about 5 years. So what typically happens is you will get big events in which the opportunity set goes up. Classic example will be the pandemic. Obviously, lots of share prices fell very heavily during the pandemic, offered you a fabulous opportunity to buy some very, very cheap shares. And so turnover went up then, and then it will go back down again, as you come out of those periods in which you just sit and harness the undervaluation of those stocks you've bought.
Value investors tend to be bottom-up stock pickers, but do you also look at the macro picture as well when you make investments?
That's the way to think about it, is that we tend to use, I suppose, other people's overreaction to macro factors to look for opportunities. And this year would be a great example, wouldn't it? If you cast your mind back to Liberation Day and the tariffs, the market went down quite substantially, but quite quickly. And then, within weeks, people had changed their mind and decided that, actually, in fact, it wasn't going to be as bad as they thought, and things were rallying again. So, had you have positioned your fund around the sort of, a very bearish macro view, you would have been proven wrong pretty quickly. So what we did that during that period was we basically used that sell-off to just top up some of our core holdings.
Yeah, and do you hold cash as well, typically, to take advantage of those market falls?
Not a lot. We kind of working capital type levels of cash, so sort of 3 to 4%, which allows you to take a bit of advantage. There's a little bit of gearing in the trust, about 5%. And typically what we'll do is we'll just rotate around the portfolio. So we might take money out of the things that have held up well and just rotate that into where we see the value in the market.
How do you know when to buy more of a company if it's not doing well, or cut your losses and sell?
I mean, this is one of the hardest things, I think, for value investors, is to know, when has the share price going down, just offering you a better opportunity to buy things, and when actually do you have to put your hands up and say, I was wrong here and the market was right. So let me give you a couple of examples. During the pandemic, we had started buying shares in Marks and Spencer's because we really believed that the new management team had a terrific strategy for turning that business round. That share price sold off very heavily during the pandemic. And our feeling then was actually the pandemic didn't really change the long-term strategy. And in actual fact, with the benefit of time, it allowed them to speed up some of those key decisions that they were making. So that was a clear opportunity where you could buy more of it at a very low price, and actually that paid off. An area which I think the jury is still out on at the moment is autos. Auto stocks have looked very cheap for the last couple of years. We own the car company Stellantis within the portfolio. The share price has performed quite poorly. We think there is potential that there's a structural issue going on here, and this is all to do with converting from petrol and diesel to electric vehicles in the end, and the amount of investment that has to go in, and so on and so forth. And so actually that we haven't sold that, but we haven't bought any more of it. So.
And what is the long-term case for value investing? We've generally seen investors move to higher growth assets or simply tracking the US market. Why does value deserve a place in portfolios?
Fun enough, I think that the case is virtually what you've just said, which is that in the long run, there's a lot of evidence to show that value is one of the factors which beats the market in the long run. And the period sort of 2010 to 2020 was actually quite an anomalous period. That was a period in which growth did better than value. Contrary to perhaps a lot of people's wisdom, value had started to outperform again from about 2021, so pretty much from the bottoms of the pandemic through today, in pretty much every area, with the one exception, which is large cap US. And of course, a lot of people focus their attention on large cap US, and they miss the fact that actually in the UK, in Europe, in Japan, in emerging markets, value has actually been beating growth since about 2021. So we've returned to that historical pattern, and touch wood, it looks like even in the US this year, after we saw the sell-off of the technology stocks, actually value is doing okay in the US this year as well. So I think the case for value now really is the start point, which is that we think growth stocks are still very, very expensive on a historic basis. Value looks very cheap on a historic basis, and that normally is a precursor of good returns.
So even after a good run for value, there is still plenty of cheap shares out there.
There are. This almost sounds sort of counterintuitive. So Temple Bar has had a very, very good few years since we took over the management of it. It's up over 180%, and yet the average price earnings ratio across the portfolio is about 9 times, dividend yield 4%. Those are quite attractive valuation metrics, and people might think, how could that possibly be the case? Of course, part of the reason is because we recycle money, so we've sold some of the more expensive things and recycled it into cheaper things. The other part of it, though, is that actually the earnings of some of the companies that we own are going up very, very dramatically. In lots of cases, because they used the fact that their shares were very, very cheap to buy back lots of very cheap stock, and that's enhanced their earnings. So the share price is only going up at the same rate as the earnings, and therefore you're not really seeing a re-rating. So yeah, despite the good performance, we think valuations are still very attractive.
Ian, thanks very much for coming into the studio.
Pleasure.
And that's all we've got time for today. You can watch more of our insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.